There's a problem hiding in plain sight, and once you see it, you can't unsee it. It's not a complex derivative or a new cryptocurrency. It's something far more tangible. The office buildings you walk past every day, a problem now estimated at nearly $5 trillion. A significant portion of it is a ticking time bomb set to go off not in a decade, but right now. What happens when the loans that built our modern cityscapes come due in a world that no longer uses them in the same way? The answer reveals a deep crack in our financial foundation. This crack connects these empty towers directly to the small banks in your community. Before we dive in, if you're interested in understanding the hidden forces shaping our economy, subscribe. According to the Mortgage Bankers Association, nearly $5 trillion represents the total outstanding debt across the entire commercial and multifamily real estate sector in the United States. But the heart of the current problem lies in one specific area: office buildings. This is the trigger for the time bomb we're facing right now. Imagine you took out a huge loan to buy what you thought was a dream investment property. The bank gave you a great deal with a very low interest rate. For a few years, everything was perfect. You had reliable tenants, the rent covered your mortgage, and the property's value was climbing. But then, two things happened at once. First, your tenants, all of them, decided they could do their jobs from home and moved out. Your property is now sitting empty. The income you relied on to pay the mortgage is gone. Second, your initial low-interest loan period is ending, and you need to refinance. But the bank looks at your empty building and new, much higher interest rates and says, "We have a problem." This is precisely what is happening to the owners of commercial office buildings across the country, but on a colossal scale. During the era of near-zero interest rates, borrowing money was cheap. Developers and investment firms took out massive loans to build and buy office towers. Now, that debt is coming due. We're facing what the industry calls a maturity wall. What does that mean? It means a massive chunk of these loans needs to be paid back or refinanced right now. According to data from the Mortgage Bankers Association, an estimated $957 billion in commercial real estate loans are set to mature in 2025 alone. It's a tidal wave of debt hitting the shore, and it's hitting at the worst possible time. The world has changed. The pandemic accelerated a structural shift toward remote and hybrid work. Companies realized they could operate with less office space, and employees embraced the flexibility. The result? Record high vacancy rates. By mid-2025, the national office vacancy rate in the U.S. was hovering at an all-time high of over 19%. In some cities, it's even higher. We're talking about nearly 1/5 of all office space in the country sitting empty. These aren't just empty offices. They are ghost towers, silent monuments to a bygone era of work. That's where the cycle turns vicious. Vacancy rises, income falls, and suddenly, less income means they struggle to make their mortgage payments. And when it's time to refinance, the value of their property has plummeted. So landlords are trapped. They can't pay their old loans with non-existent rent, and they can't get new loans because their buildings are worth a fraction of what they once were. For many, the only options are to hand the keys back to the bank or declare bankruptcy. We're already seeing this happen. Major players like Blackstone and PIMCO have strategically defaulted on office building loans, deciding it was better to walk away than to keep pouring money into a losing asset. So, a few big-shot real estate investors lose money. Why should that matter to you? This is where the story gets much more serious. The risk isn't just contained within the world of high finance. It's deeply embedded in the banking system. When you think of the financial system, you probably think of the giant household name banks. The J.P. Morgans, the Bank of Americas. And while they certainly hold some of this commercial real estate debt, they are not the ones most exposed. The real risk lies with thousands of small and regional banks scattered across the country. The banks that provide loans to local businesses. The banks where your neighbors might work. Here's a crucial statistic from Goldman Sachs. Small and mid-sized banks hold approximately 67% of all commercial real estate debt. Let me repeat that. 2/3 of this massive, troubled loan portfolio sits on the books of smaller banks. For these institutions, this isn't just a slice of their business. It's a huge part of it. For small banks, CRE loans make up about 30% of their total assets. For the big banks, it's only 6%. They are disproportionately exposed to this single, struggling sector. So what happens when building owners start defaulting in large numbers? These small and regional banks will be hit with massive losses. Remember the Silicon Valley Bank collapse in 2023? It showed us how quickly a regional bank can fail when its core assets suddenly lose value. In that case, the trigger was government bonds. This time, the trigger could be commercial real estate loans. A wave of defaults in CRE would force these banks to tighten their lending standards dramatically to preserve capital. This is what economists call a credit crunch. Suddenly, the small business owner who wants to expand, the family trying to get a mortgage, or the entrepreneur seeking a startup loan, it's a no from the bank. The flow of credit that acts as the lifeblood of the economy gets choked off. Economic growth stalls, and a problem that started in a handful of empty office towers has now spread to Main Street. The Federal Reserve and other regulators are well aware of this risk. They are not sitting idle. They are actively encouraging banks to work with borrowers. They are trying to extend loan terms and find solutions other than foreclosure. They are trying to defuse the bomb, one wire at a time, but the sheer scale of the problem is immense. The maturity wall doesn't end in 2025. The challenge continues over the next several years. Hundreds of billions of dollars in loans are coming due each year. This is a slow-motion crisis, one that will play out over time. We've explored the what, the why, and the how. We see a nearly $5 trillion mountain of debt, a structural shift in how we work, and a risk that is dangerously concentrated in the most vulnerable part of our banking system. The picture is concerning. It's a clear and present danger that has, for the most part, been hiding in plain sight. We aren't talking about a hypothetical scenario. We are watching it unfold in real time. As we stand here today, the crucial question on everyone's mind is, how bad could it get? Does this have the potential to be another 2008-style financial crisis? There are some chilling parallels: a collapsing real estate market, over-leveraged banks, a sense that the experts are telling us everything is under control. But there is also one profound difference that separates today's situation from the great financial crisis. Understanding that difference is the key to knowing what comes next. And that is exactly what we will break down in our next video. Are we repeating 2008? 5 undeniable signs and one crucial difference. We will put the two crises side by side and give you the data you need to see the full picture. So if you want to be prepared, make sure you're subscribed and have notifications turned on. And I want to hear from you. Based on what you've seen today, how concerned are you about the commercial real estate market? Let me know in the comments below. Thank you for watching. This content is for educational purposes only and does not constitute financial advice. Please consult a qualified financial professional for personal investment decisions.